or more. Essentially, they would receive pennies on the dollar. But retirees are not the only ones facing catastrophic consequences if Congress does not act. Active workers are in jeopardy of losing their jobs. According to one conservative economist, the failure of the Central States Plan would result in the loss of 50,000 jobs in 2025, and that's just one plan in 1 year. Think about what could happen if scores of other plans fail as is currently projected. Participating employers are at real risk too. Employers tell us that their pension liabilities are hurting their ability to hire personnel or expand operations. They also tell us that some of their banks and lenders are already starting to question their credit worthiness. For these employers, the multi-employer pension crisis is not years away. It is hurting their businesses right now. Chairman Scott and I invited the U.S. Chamber of Commerce to be one of our witnesses here today to highlight the urgency of this crisis to America's businesses and their workers. The Chamber and others have correctly noted that if retirees see their pension cut to essentially zero, they will become reliant on social safety net programs that will have to be funded by taxpayers. At the same time, there also will be a loss of tax revenue. So we should be mindful of the cost to the taxpayers if Congress does not act to address the multi-employer pension crisis. According to one estimate, congressional inaction would cost as much as $103 billion in lost federal tax revenue and $138.3 billion in increased social safety net spending over the next decade. To date, there has been just one bipartisan legislative solution introduced to address the multi-employer pension crisis, H.R. 397. The Rehabilitation for Multi-Employer Pension Act upholds the pension promise made to these retirees who are at risk of losing everything for which they worked and sacrificed over a lifetime. I'm proud to be one of the leading supporters of this bill, and I believe that Congress should act on it. Today's hearing is an important opportunity to learn more about the multi-employer pension system, the urgency of the crisis confronting it, and the bipartisan solution to fix it. It also is a reminder that the fundamental question for Congress to consider is not how much it costs to fix the multi-employer pension crisis, but how much it will cost retirees, employers, and taxpayers if we do not act. I want to thank all of our witnesses for being with us today, and I look forward to your testimony. I now recognize the distinguished ranking member for the purpose of making an opening statement. Ranking Member Wahlberg.
Madam Chair, thank you, and may I quickly congratulate you on your chairmanship, and I look forward to working with you in the coming years. Together we've done this in the past on Workforce Protection Subcommittee in the same mode, just kind of reversed, and I know that we can work together. And I appreciate the fact that you've made this your first hearing. This is a topic of great concern, and it ought to be a topic of bipartisan concern. The looming insolvency of the Pension Benefit Guaranty Corporation's PBGC multi-employer insurance program is one of the greatest challenges facing American workers who participate in multi-employer pension plans. Collectively, 95% of multi-employer plan participants are in plans that are less than 60% funded. This large-scale breakdown of the multi-employer pension plan system is putting immense strains on the PBGC, which serves as the backstop for defined benefit plans and provides financial assistance to underfunded plans. The PBGC is currently facing a $54 billion deficit. The agency is on track to completely be wiped out in just 6 short years. Extreme levels of plan underfunding are an urgent concern. Workers and retirees must have peace of mind when it comes to their hard-earned retirement benefits and employers must have certainty when it comes to their obligations under these plans. It's essential that we work together to stop the hemorrhaging of underfunded plans and minimize losses for plan participants as much as humanly possible. The real-life implications of this problem are real and vast. I've met with countless retirees in my district, and I hear the fear, the anger, and the concern in their voices as they talk about the prospect of having to live on a fraction of the income that they were promised. There's nothing fair or excusable about a 75-year-old retiree with health care concerns and medical issues standing in front of me finding out that the pension he was promised just isn't funded. And like most issues we talk about in this committee, the effects of one serious problem are felt in many quarters. I've had many conversations with business owners in Michigan as well who tell me that the unfunded pension liabilities they carry make it impossible to innovate or do anything other than maintain the business models they have, with the frustration of no alternative for the outcome in the end. Republicans and Democrats have a history of bipartisan cooperation on this issue. In 2014, the Republican chairman of this committee, John Klein, and Democrat ranking member George Miller put aside political differences and brought stakeholders to the table to craft the Multiemployer Pension Reform Act, which was later signed into law. While a decision by President Obama's Treasury Department limited the effectiveness of the legislation, the across-the-aisle cooperation that went into the legislation acted as a harbinger for future, I trust, bipartisan efforts on this issue. Part of the way we need to approach these solutions is to adopt reforms that address the structural flaws within the plans. When the multiemployer pension system was constructed decades ago, fundamental flaws were unfortunately built into the system's foundation. If you build a house on a weak foundation, no quick fixes will prevent that house's collapse in the future. If Congress does not reform the architecture of the multi-employer pension system, then it won't matter how much money we throw at this problem. These problems will persist and put future generations of workers at risk of the very same chronic underfunding that plagues pensioners today. We must also pursue every possible avenue to protect taxpayers from proposals that are fiscally irresponsible and don't work in the end. Multi-employer pension plans were always privately negotiated by companies and labor unions. Taxpayer dollars have never been used to support or subsidize these commitments, and it would be inappropriate for the federal government to underwrite compensation costs for a select group of private employers. I can't state emphatically enough that far-reaching reform, fiscal responsibility, and bipartisanship must be the principles that guide us as we work to solve this problem. It's a human problem. I am hopeful about this committee's ability to work together on this issue. We are on the same side and want to protect workers, taxpayers, retirees, and their families. The way forward won't be easy, but millions of Americans are counting on us. We owe it to them to set aside our political differences and come to the table to find a bipartisan solution to secure their future. And Madam Chairperson, I commit myself to that alongside of you, and I yield back.
Thank you. Thank you. Without objection, all other members who wish to insert written statements into the record may do so by submitting them to the committee clerk electronically in Microsoft Word format by 5:00 p.m. on March 21st, 2019. I will now introduce our distinguished witnesses. First, we have Mr. Josh Shapiro. He serves on the board of directors of the American Academy of Actuaries and chairs its Pension Practice Council. Welcome. Mrs. Mary Moorkamp is the Chief Legal and External Affairs Officer at Schnuck Markets, which is a family-owned grocery chain in St. Louis, Missouri. Welcome. Mr. James Morgan is a bakery and confectionery union and industrial international pension fund retiree. Welcome. Dr. James Norton is an assistant professor at the Kellogg School of Management at Northwestern University. Welcome. Mr. Glenn Spencer is a senior vice president at the U.S. Chamber of Commerce. And Dr. Charles Blahouse holds the J. Fish and Lillian F. Smith Chair at the MacArthur Center at George Mason University. Welcome. Mariah Becker is the Director of Research and Education for the National Coordinating Committee for Multi-Employer Plans. Welcome. We appreciate all of the witnesses for being here today and look forward to your testimony. Let me remind the witnesses that we have read your written statements and they will appear in full in the hearing record. Pursuant to Committee Rule 7D and committee practice, each of you is asked to limit your oral presentation to a 5-minute summary of your written statement. Let me also remind the witnesses that pursuant to Title 18 of the U.S. Code Section 1001, it is illegal to knowingly and willfully falsify any statement, representation, writing, document, or material fact presented to Congress, or otherwise conceal or cover up a material fact. Before you begin your testimony, please remember to press the button on the microphone in front of you so that it will turn on and the members can hear you. As you begin to speak, the light in front of you will turn green. After 4 minutes, the light will turn yellow to signal that you have 1 minute remaining. When the light turns red, your 5 minutes will have expired, and we ask that you please wrap up. We will let the entire panel make their presentation before we move to member questions. When answering a question, please remember to once again turn your microphone on. I will first recognize Mr. Shapiro.
Thank you. Chairwoman Wilson, Ranking Member Wahlberg, and distinguished subcommittee members. On behalf of the Pension Practice Council of the American Academy of Actuaries, I am Josh Shapiro, Vice President Pension at the Academy. I am honored to have this opportunity to provide testimony to the Health, Employment, Labor, and Pensions Subcommittee of the House Education and Labor Committee. The Academy is a strictly nonpartisan professional association representing U.S. actuaries before public policymakers. As a member of the Academy, I am bound by its qualification standards, its code of conduct, and the actuarial standards of practice. I am here to provide a summary of how multi-employer pensions operate and their current funding outlook. More than 10 million active and retired workers participate in approximately 1,250 active multi-employer pension plans. These plans are common among collectively bargained workforces in industries that are characterized by small businesses, employee mobility between employers, and lower wage levels. Through economies of scale and the pooling of risks, multi-employer plans have succeeded in providing lifetime retirement income to millions of workers who would otherwise not have had access to effective and affordable retirement benefits. While the vast majority of multi-employer plans are faring well, unfortunately there are roughly 130 plans covering more than 1 million participants that are expected to fully exhaust their assets in the coming 20 years. The first decade of the 21st century was the worst period on the financial markets since the Great Depression. The S&P 500 index lost 37% of its value in 2008 alone. And nearly all retirement plans, including multi-employer plans, experienced significant declines in their assets during this decade. Most multi-employer plans have been able to recover from these losses using the same tools they have always used throughout their history. Specifically, they have relied upon a combination of higher bargained contribution rates and reductions to future benefit accruals. The plans that are expected to run out of money have generally also experienced significant declines in their populations of contributing employers and employees. While each situation is different, employer bankruptcies, technology improvements, regulatory changes, and declines in certain industries have all contributed to these trends. For plans that have significantly diminished bases of active employees and employers, the measures available to trustees have been ineffective and the plans are unable to recover. After a multi-employer plan exhausts its assets, it receives financial assistance from the Pension Benefit Guaranty Corporation. This assistance allows the plan to continue to pay participant benefits, but only at the level that is guaranteed by the PBGC. The maximum amount that the PBGC will guarantee for a participant with 30 years of service is approximately $1,100 per month. In plans that cover middle-income workers, this guarantee could represent a benefit cut of 50% or more. The PBGC's multi-employer insurance program is expected to run out of money by 2026. Because the PBGC receives all of its funding from premiums paid by plans and is not supported by general revenues, if the multi-employer insurance program runs out of resources, the guarantee would decline to what it could afford on a pay-as-you-go basis out of annual premium receipts. In this situation, participants in insolvent multi-employer plans could see their benefits cut by 90% or more. Participants affected by benefit reductions of this magnitude might need to rely on social safety net programs. The multi-employer pension system stands at a crossroads. These plans have allowed millions of American workers to retire with reliable lifetime income that most would have been unable to achieve had these plans not been there. However, for a significant minority of plans, the system has proved not to be resilient enough to withstand the combination of demographic trends, industrial shifts, and economic declines that have occurred in recent years. As a result, more than 1 million participants face the possibility of losing their retirement benefits, and thousands of businesses are in jeopardy. Congress faces a dual challenge. Action is needed to address the looming crisis that will occur when both plans and the PBGC exhaust their resources and reach the point of insolvency. The multi-employer system also needs to be reformed so it can continue its invaluable mission of providing retirement income to people who need it, while also ensuring that the system does not fall into crisis again. The Pension Practice Council of the American Academy of Actuaries looks forward to continuing to provide objective and unbiased actuarial analysis to lawmakers and their staffs as they work to address these difficult challenges.
Thank you, Mr. Shapiro. We will now recognize Ms. Moorkamp.
Madam Chair Wilson, Ranking Member Wahlberg, and members of the committee. I'm Mary Moorkamp, Chief Legal Officer at Schnuck Markets, based in St. Louis, Missouri. Thank you for the opportunity to testify today. I'm here to describe how the multi-employer crisis already affects businesses today. You may hear similar testimony from other witnesses, but this is personal for me and my thousands of Schnucks teammates. Schnucks is a third-generation, family-owned retail grocery chain. We were founded by Anna Donovan Schnuck in 1939 as a way to feed her family and neighbors during the Depression. Nearly 80 years later, we have almost 15,000 teammates in 119 stores in 5 Midwestern states. We are proud of our local heritage, and our mission of nourishing people's lives goes well beyond selling groceries. There are roughly 5,400 businesses that contribute to approximately 130 multi-employer funds that are going insolvent. For many of these businesses, a fund's insolvency, and more immediately, the potential threat of insolvency, is already affecting their business operations. For example, lenders, rating agencies, and auditors are increasingly concerned with the impact of a central state's insolvency. As a company's withdrawal liability becomes estimable and probable, and these are accounting terms, there could be greater pressure to record the liability on financial statements. Recording the liability will affect each business differently. For many small businesses, their withdrawal liability could exceed the value of their business, so booking the liability will make them insolvent. Mid-sized employers are also at risk. Some lenders already have increased their borrowing charges, and I've heard of situations in which lenders have refused to make business loans due to central states pending insolvency. Sadly, some business owners don't even know that their business has withdrawal liability, and we're seeing those situations right now. For Schnucks, the looming Central States insolvency makes us reluctant to grow our business. If we open a store in a new market, we have to hire a driver to transport product to the store. If the driver is covered by our CBA with the Teamsters, the driver must go in Central States. We estimate that each new driver increases our exposure by as much as $268,000 per teammate. The current situation also limits expansion opportunities in our current markets. We face recruiting and retention issues as potential new hires are aware of the plight of Central States and don't want to participate in the plan. Some argue that these concerns reflect a worst-case scenario. They say that Central States insolvency won't trigger withdrawal liability. We cannot predict the future actions of lenders, the accounting profession, our suppliers, the IRS, and the PBGC. But we do know that even if the insolvent fund doesn't trigger withdrawal liability, Schnucks and other businesses will have to continue making contributions to Central States. Meanwhile, our teammates will accrue a benefit that at most equals the paltry PBGC minimum, assuming the PBGC remains solvent. This is a best-case scenario if Congress doesn't act. To some extent, we're already doing this. We provide a 401k plan to our Teamster warehouse teammates in addition to the Central States pension. For these teammates, not only do we contribute $342 per teammate per week to a pension fund from which they may receive next to nothing, but we also contribute to a 401k plan. This double retirement benefit is not sustainable in our penny margin business, nor is it fair to our other teammates. Simply put, if the multi-employer system is not stabilized quickly, the effects on businesses, workers, retirees, local communities, and the federal government will be significant and harmful. These problems are manifesting themselves today, not 2025. In my written statement, I offer 6 guiding principles for the committee's consideration. First, a solution must restore these plans to solvency and stabilize the system. Second, a solution must be bipartisan and bicameral. Third, the solution must be implemented quickly. Fourth, it will necessarily require considerable federal assistance. Fifth, the cost must be spread among stakeholders in a fair and equitable manner. And lastly, the solution must include safeguards to ensure this crisis never happens again. The pension crisis transcends party lines. This is not a Republican or a Democrat issue, nor is it a union or employer issue. We're grocers. Schnucks has been in business for 80 years, and we hope to be around for another 80 years. But the pension crisis presents an existential threat to employers. It's Schnucks' #1 threat as we look at our long-term business plan. And we stand ready to work with you and the committee in your efforts to solve this crisis. Thank you again for allowing me to testify, and I'll be happy to answer questions.
Thank you, Ms. Moorcamp. We will now recognize Mr. Morgan.
Good morning. Thank you, Madam Chairwoman. My name is James Morgan, and I live in Blue Island, Illinois, in suburban Chicago. I retired after working 33 years at Hostess Brand Wonder Bread Bakery, first in Chicago, then in Hoskins, Illinois, a Chicago suburb. I worked at the bakery until the company went bankrupt and closed its doors in 2012. I'm currently collecting my pension from the Bakery and Confectionery Union and International Pension Fund, known as the B&C Fund, and working part-time to help make ends meet. During my career at Wonder Bread, I was active in my union, the BCTGM, local union #1, with nearly 3,000 members and several thousand retirees. I served as shop steward, chief shop steward, and I was a member of the local union's executive board. During my 33 years in the bakery, I worked many different jobs, including mixer and oven operator. Working in an industrial bakery is a very extremely physical, demanding job. You are on your feet at least 8 hours a day, and usually we work a lot of overtime. In the summer, the temperatures in the bakery could get to 100 to 120 degrees. It was stifling. For much of my career as a mixer, I had to lift 100-pound bags of ingredients in 100-pound and 50-pound bags and pour it into the mixer every day, all day. We worked weekends, holidays, and we never had 2 consecutive days off in a row. That's how the bakery industry is. 33 years in the bakery took an enormous toll on your body. It's very rough on your back, your neck, your feet, your arms, your legs. It's very grueling. Thanks to my union and strong contract that we negotiated, my coworkers and I earned a middle-class wage and good benefits for the hard work that we did. No benefit was more important to us than our defined pension benefit. We negotiated and fought for our pension because we knew having that pension meant that we would be able to retire with dignity after a lifetime of very hard work. In fact, having a good pension was so important to us that we would often negotiate less in pay raises in favor of increasing our negotiated pension benefit level. In some years, many of us took a portion of all of our negotiated pay increase to purchase additional pension benefits. This was money out of our own pockets. That's how much we valued our pension. As chief shop steward, I knew everyone working in that bakery. We were proud to be making the most famous bread in the country, Wonder Bread. We gave it our all every day. If the bakery would have not closed, I'd probably still be working there today. We were working to provide for our families, and we were working for a decent retirement. It's very disturbing to me when I hear people saying that the pension was given to us by the company. Hostess did not give us a pension. We bargained for it as a part of our comprehensive package. Those benefits were a part of our earnings. In August of 2011, the CEO of Hostess Brand sent a letter to every employee saying that the company was suspending the contributions it was obligated to make to the BNC pension fund according to our collective bargaining agreement. He said the suspension of the contribution were going to be temporary. That was not true. The company never resumed making payments to the fund. They never intended to. The executives were just sucking out whatever money they could from the company and the bakeries. In fact, during the bankruptcy, a number of executives actually took huge pay raises, some as much as 300%. 15 months later, the company went out of business. Our bakery was closed, and we were out of work. Not only were we out of work, we also had new fears about the future of our pension benefits. We learned shortly after the bakery closed that the federal bankruptcy courts allowed Hostess just to walk away from its pension fund contributions and obligations. That was nearly $1 billion. The enormous financial damage done to the BNC fund by Hostess Brand meant that we could lose everything we worked for and sacrificed for through no fault of our own. The Hostess executives and private equity owners who mismanaged the company ran it into the ground and put it into bankruptcy, walked away with millions of dollars. They left the dedicated workers who helped build the company and created the profits with an uncertain future in our retirement years. Would our guaranteed benefits always be there for us? Would our pension checks get cut as we got older? How would we pay our bills? Will we be able to afford our prescriptions? Will we be a burden on our children or other family members? These are the questions that have been hanging over our heads since the company closed its doors. We are fearful about what will happen to our pension. It is a very stressful time for all of us. I know that the union leaders and the pension fund are working as hard as they can to protect the pension benefits for every retiree and every active worker in the fund. My union and the BNC pension fund strongly support H.R. 397. They believe long-term, low-interest loans will lead to long-term solvency of our pension fund and help the retirees like me who depend on our pension checks to get by. It is responsible bipartisanship legislation that will effectively address the pension funding crisis in our country. My pension benefits have not made me rich, not at all, but my pension check each month is the only way I know I'm able to make ends meet. If I lost those benefits or those benefits were cut, it would be devastating. I definitely would not be able to pay my bills each month, afford groceries, or take care of necessary medical needs. I don't know what I would do. I know almost all of my former coworkers are in the same position. Madam Chairwoman, we are not asking for a handout. We earned our pension through hard work and sacrifice. We did our part by putting in an honest day's work under difficult conditions. All we are asking for is fairness. Madam Chairwoman, I would like to thank the committee for the very important work you are doing for the retirement security of all American workers. Thank you for the opportunity to appear before you today. It has been an honor and a privilege.
Thank you. Thank you, Mr. Morgan. We will now recognize Dr. Norton.
I'd like to thank the chairwoman, Frederica Wilson, and ranking member Tim Walberg for the opportunity to present today. To begin, I'd like to outline the basic framework for multi-employer plan contributions, as that is an important driver of the current crisis. At a high level, there are two components: the cost associated with newly promised benefits and the cost associated with funding a portion of previously promised but currently unfunded benefits. The dramatic increase in employer costs over the past 15 years is primarily related to the second component. In fact, the dollar amount of underfunding has approximately tripled to more than $600 billion since 2005, when legislation was first drafted to address the issues of multi-employer plans. To understand why this is happening, you need to understand the source of the current crisis. Consider the following simple thought experiment. You exchange part of your current wages for an annuity benefit so that you will have regular income during retirement. If this transaction is with an insurance company, your foregone wages will be invested primarily in low-risk bonds whose payouts are chosen to match the payouts of your annuity benefit. The insurance company will also require that you pay an amount that is equivalent to the cost of your annuity, i.e. you get what you pay for. If this transaction is with your union as part of a multi-employer arrangement, your foregone wages will be invested primarily in the stock market. In addition, the multi-employer plan may only collect a fraction of the value of your annuity benefit, hoping that it can recoup the difference from future generations of union members or through extraordinary investment performance. This deviation by multi-employer plans from how insurance companies manage annuities is the driver of this entire crisis. If multi-employer plans collected actuarially sound contributions and purchased annuity contracts, there would be no crisis. Each participant would be receiving or would be scheduled to receive his or her promised benefits. Technology bubbles, industry deregulations, employer withdrawals, none of those would have any effect. For this reason, moving to an annuity-type framework is a critical first step in addressing the current crisis, because it will at least freeze the amount of the total underfunding. Stock market investing generates higher expected returns, but does so with significant additional risk. Those types of risks should only be taken if adverse events can be managed, and that is clearly not the case with the multi-employer plan system. In fact, that system is designed so that the volatility associated with stock market investing will inevitably lead to substantial underfunding. I am not aware of any convincing reason why multi-employer plans should invest primarily in the stock market. Multi-employer plans are essentially an organization that manages the contributions of its members to provide retirement income. Very similar to what an insurance company does. One consequence of an annuity-type framework is that contribution requirements will be higher because they will be based on the use of a lower discount rate. However, the increased cost that comes with using the actual value of what is promised is not a persuasive reason to avoid using it. Continuing to use unreasonably low estimates of the benefit promises will only lead to future crises. In closing, I want to highlight that a well-run defined benefit pension plan should reflect the principle that you can rely on a set benefit in retirement. Moving to an annuity-type framework is necessary for this principle to become a reality. A promise that is partially funded and invested in risky securities is a promise that is unlikely to be kept. I also want to highlight the importance of urgent action. Delays will inevitably lead to larger deficits and more difficult decisions, as we've seen over the past 10 years. Thank you again for this opportunity, and I look forward to answering any questions you may have.
Thank you, Dr. Norton. We will now recognize Mr. Spencer.
Madam Chair Wilson, Ranking Member Wahlberg, I'm Glenn Spencer, Senior Vice President for Employment Policy at the U.S. Chamber of Commerce, and I want to thank you for holding this hearing today on the financial troubles facing the multi-employer pension system. For many plans and plan participants, this has indeed become a crisis. But it's also a crisis for the employers who fund these plans and the broader economy as well. Although many multi-employer plans were fully funded through the 1990s, this came to an end in 2000 when the price of technology stocks dropped. Many investors suffered, but multi-employer plans were hit twice as hard because of demographic issues facing these plans, particularly the decline in the ratio of active workers to retirees. The 2008 recession led to further declines in funding levels and only exacerbated the demographic challenges. For example, many multi-employer plans have ratios of 1 active worker for every 2, 3, or even 5 retirees. This is simply not the basis for a sustainable plan. In fact, certain plans will enter, if they're not already in, what one could call a death spiral, where there's no realistic chance of recovery regardless of investment options or interest rate assumptions. And this has major implications not just for the people in the plans, but the employers who are part of that multi-employer system. Amongst the biggest problem facing employers is withdrawal liability. Now, while withdrawal liability is not actually booked until a plan actually terminates, the exposure to withdrawal liability is having impacts on employers now. When banks or other creditors know that a company is exposed to a multi-employer plan, a struggling multi-employer plan in particular, they begin to question the creditworthiness of that business, which can lead to less than optimal lending rates or even denials of credit. Further, employers may lose the opportunity to expand business operations through mergers because companies that are not part of the multi-employer system may not wish to expose themselves to withdrawal liability. And finally, small family businesses may decide not to pass that business down to their heirs to avoid passing down withdrawal liability. And even worse, some may find that selling their business to fund their own retirement has become impossible because withdrawal liability is higher than the value of the business. The second challenge is high contribution rates. As unfunded liabilities have increased, employers have faced rates that have doubled or even tripled. Some employers are paying as much as $15 or more per hour to plans for every hour that an employee works. Now, while most employers would rather absorb that higher contribution rate than incur withdrawal liability that could bankrupt them, the ultimate effect is that employers become less competitive. And it's questionable whether employers can sustain ever-increasing rates over the long term. A third significant problem is the potential contagion effect. Many employers contribute to more than one multi-employer plan. Should an employer with exposure to many plans face withdrawal liability from any one of those plans, it could go bankrupt. At that point, all the other plans in which it participates will face increased financial pressure, possibly causing them to become insolvent and triggering withdrawal liability for other employers in those plans, leading to a cascade of bankruptcies and failing plans. Now, while no extremely large plan has gone insolvent just yet, several are projected to do so within the next 5 to 10 years. Now, the Chamber recognizes there's no easy answers. Last year, we jointly issued principles to help guide Congress towards a solution. First, Congress must recognize that rescue legislation is urgently needed. This problem is only going to get worse the longer we take to act. Second, struggling plans will need financial assistance. Our recommendation is for long-term, low-interest loans that will protect taxpayers from financial liability. Third, all parties will have to be part of the solution, including plan beneficiaries and participating employers. Fourth, while the PBGC may ultimately need more money in the form of increased premiums, these increases must be evaluated after tools to restore the solvency of these plans are put into place. Finally, composite plans must be authorized so that healthy multi-employer plans can stay that way. We realize these principles are just a start, and we look forward to working with Congress to find a bipartisan solution. Again, I want to thank you for holding this hearing today, and in addition to my statement, we're submitting for the record a report we released on this issue last year that goes into these issues in much greater detail. So thank you.
Thank you. Thank you, Mr. Spencer. We will now recognize Mr. Blahhouse.
Thank you, Chairwoman Wilson, Ranking Member Wahlberg, and all the members of the subcommittee. Greatly appreciate this opportunity to discuss the challenges facing multi-employer pensions. I've submitted additional background material with my written testimony, but in my spoken remarks, I'd like to focus on 3 primary points. First point is simply, multi-employer pensions do indeed face a very urgent problem. And the immediate manifestation of that problem, of course, is the $54 billion deficit in the multi-employer pension insurance program operated by the Pension Benefit Guaranty Corporation. And that is projected to be insolvent by 2025. And as you've noted, Chairwoman Wilson, if this insurance program goes bankrupt, workers in insolvent pension plans will not even get the benefits that were supposedly insured, because PBGC will not have the funds available to pay them. And yet, that insurance shortfall represents only the tip of the iceberg. The best available estimates are that there's more than $600 billion of underfunding in multi-employer pensions nationwide. So a failure to reform multi-employer pensions threatens potential costs to workers, to the insurance system, and under some proposals to taxpayers that are more than 10 times larger than currently visible on PBGC's balance sheet. Second point is that solving this problem requires recognizing and addressing its causes. The multi-employer insurance program is facing its worsening crisis at exactly the same time that the single-employer system is stabilizing. Now, both systems face similar demographics, and both systems have been through the same financial market shocks, so why the difference? There's 2 main reasons. One is that the multi-employer system suffers from a number of specific problems, including inaccurate valuations of plan liabilities and assets, lax funding rules, inadequate contribution and withdrawal liability requirements, and inadequate and poorly designed insurance premium assessments. Second, the multi-employer system faces additional unfunded liabilities from benefits that are obligated to so-called orphan workers. And these are the workers whose employers have withdrawn from sponsoring a plan, but whose benefits the continuing sponsors remain responsible for paying. Now, the main valuation problem is that the law permits multi-employer plans to greatly understate their liabilities by using inflated discount rates to translate future benefit obligations into present value terms. There is a broad consensus among economists on how to discount pension liabilities, and yet most plans' actuarial practices and federal funding rules simply disregard this consensus. And the problem is very simple. If pension liabilities are not properly recognized, they won't be funded, and that is what has happened throughout the multi-employer pension system. Moreover, average insurance premiums per person paid by multi-employer plans are less than 1/6 what they are for single-employer plans. And whereas underfunded single-employer plans are subject to variable rate premiums, underfunded multi-employer plans are not. And it means that those plans' premium payments do not reflect the PBGC's risks of insuring them. Now, the aforementioned orphan worker problem is driven in large part by flawed withdrawal liability rules. The way it's supposed to work is that an employer who withdraws from plan sponsorship, they're supposed to make a withdrawal liability payment that's equal to their share of the plan's unfunded vested benefits. But there's various limitations and exceptions that often cause actual withdrawal payments to fall well short of that amount, which leaves other sponsors remaining in the plan facing a larger inherited shortfall. And research does confirm that the most underfunded multi-employer plans indeed have a much greater population of orphan workers than better funded plans on average. So to effectively address the crisis, reforms must correct both problems, the flawed valuation, premium, and funding rules, as well as the inadequate withdrawal liability design and the unfunded orphan worker obligations that have arisen from that. Final point, Chairwoman Wilson, is that resolving this crisis, as I don't need to tell you, is extremely difficult. But one mistake I would say should be avoided, and that's procrastinating. And procrastinating could take the form of propping up plans with federal subsidies, whether they're packaged as loans or otherwise, without fixing the underlying problems. This would cause plans' underfunding to continue to mushroom. It would render their inevitable collapses more expensive, and it would actually be an escalation of the policy failures to date, and would result in lawmakers facing an even worse version of this crisis in the future. Accurate measurement of a plan's funded status is the irreplaceable step in that no solution is going to work without it. Lawmakers can craft any contribution schedule they choose, however lenient, however stringent, once the shortfalls are accurately measured. But while funding requirements are rightly a matter of policy discretion and legislative negotiation, pension liability measurements are not. Those simply reflect a reality that cannot be avoided and should not be obscured. In closing, Chairwoman Wilson, in addition to repairing flawed measurement, funding, and premium rules, creative measures to address troubled plans' orphan liabilities are worth considering. But regardless of the policy approach taken, the goal of any reform should be a viable and secure multi-employer pension system. Viable because sponsors only promise benefits that they can fund, and secure because they fully fund the benefits that they promise. Thank you.
Thank you. Thank you, Mr. Blauhaus. We will now recognize Ms. Becker.
Chairwoman Wilson, Ranking Member Wahlberg, and members of the committee, my name is Mariah Becker. I'm the Director of Research and Education for the National Coordinating Committee for Multi-Employer Plans, or the NCCMP. Thank you for the opportunity to appear before you today as you consider the crisis facing the multi-employer system, its plans, participants, employers, and the nation as a whole. The multi-employer system plays a substantial role in supporting the finances of the U.S. government, state and local governments, households, and the economy of the United States. In 2015 alone, the multi-employer system provided $158 billion in taxes to the U.S. government. We provided $41 billion in pension income to our retirees and paid more than $203 billion in wages to our 3.8 million active workers. Combined, that pension and wage income supported 13.6 million American jobs and generated $1 trillion in GDP. The vast majority of multi-employer plans today are in good shape, but there is a significant crisis looming without congressional action, and it is critically important that Congress act this year. If Congress does not act, around 10% of multi-employer pension plans covering 1.5 million participants will inevitably run out of money to pay benefits within the next 20 years. As you work to decide how to avert this crisis, it's incredibly important to preserve and protect the majority of plans that are currently in solid financial health. Multi-employer plans play a vital role in providing the modest but essential lifetime retirement income to around 10.4 million participants that allows these working-class Americans to retire with dignity. Mr. Morgan spoke earlier about the personal impact of this crisis for retirees. I'd like to add some numbers to that just to give you a sense of the scale that we're talking about. Take an example participant who currently earns $27,300 a year in retirement. These aren't golden parachute benefits. When his plan becomes insolvent, this retiree would get $12,870 a year, assuming he worked a full 30-year career. This is a life-altering reduction. But we know that the PBGC will be insolvent in 2025. At that point, this retiree, who had planned his retirement and savings based on $27,300 a year from his plan, will get around $1,365 a year, or $114 a month. Life-altering doesn't begin to describe it. On the employer side, there will be further challenges for all employers in the system when a systemically important plan like the Central States Pension Fund fails. We've already seen the beginning of market-based responses as there is a greater understanding of the upcoming insolvency of Central States, including higher costs for bank credit or restricted credit for the plan's employers. These market-based responses will expand at the insolvency of Central States, including the Financial Accounting Standards Board, or FASB, which is likely to revisit its multi-employer pension accounting standards. This will impact the availability of credit and capital for all contributing employers in every multi-employer plan. But just as there are severe costs for plan participants and employers, taxpayers at the federal, state, and local level will all bear an enormous burden if Congress does not intervene to prevent the multi-employer solvency crisis. NCCMP worked with the National Institute on Retirement Security, or NIRS, and the Siegel Group to develop an economic impact model of the failure of the plans currently facing insolvency. For only the plans that are currently in critical and declining status, we estimate that the U.S. government will lose between $32 billion and $103 billion in tax revenue over the 10-year budget window from the lost pension and wage income and economic output, depending on the level of employment losses that occur. In addition to the lost tax revenue, we estimate that the U.S. government will have new safety net spending over the 10-year budget window of $138 billion, for a combined total 10-year cost to the U.S. government of not finding a solution to the multi-employer pension crisis of somewhere between $170 billion and $240 billion. It's important to note that these costs will continue for decades after the first 10-year window, and so may the cost of any solution. Because one proposal to address this crisis includes a 30-year federal loan program, we estimated the net present value of the 30-year economic costs. The lost federal tax revenue had a net present value between $68 billion and $215 billion, and the net present value of new safety net spending was $264 billion. This brings the combined 30-year costs to somewhere between $332 billion and $479 billion. The actual costs are likely to be higher, maybe significantly, if there are more critical and declining status plans in the future, if the broader contagion among employers is substantial, and depending on the scale of the market-based responses of FASB, the banks, and the capital markets. The costs of inaction are substantial and increase dramatically for all stakeholders in the system the longer we wait. Thank you for the opportunity to share these thoughts with you today, and I look forward to your questions.
Thank you, Ms. Becker. We will now proceed to member questions. Under Committee Rule 8A, we will now question witnesses under the 5-minute rule. I will now yield myself 5 minutes. Mr. Morgan, it is clear from your testimony how much pride you took in your work as a mixer and oven operator. Can you please describe the different jobs you worked in the bakery?
Besides mixer and oven operator, I worked in the sanitation department. I worked in the wrapping room at the end of the production line. I worked in the middle of the production line as the divider operator as we cut the bread up. I worked in the molding department where we mold the bread. All this was part of an assembly line. The mixing room started the process, and then it went through the different stages of processing: dividing, molding, proofing, and then final wrapping room production. So I worked every part of the line, even sanitation, even receiving. My 33-year career at Wonder Bread, I did almost every job in the bakery.
Mr. Morgan, can you please tell us why you and your fellow union members sacrificed wage increases during contract negotiations for increasing your pension benefit level, and why was that important to all of you?
Well, as I think back on that, when I first started in the bakery, I was 19 years old, and I used to go to all the union negotiation meetings, and a lot of the senior members, that's what they were doing. They were putting more money into that pension. I was young, and I didn't know anything, but they drug me along and said, hey, you're going to need a pension one day when you retire, when you get older. I never wanted to put extra money or my wage increases into the pension. But they guided me through this. The senior members guided me through this and said, you're going to need that money. And quite literally, I did need it after the bakery closed. So it was always a good, and I taught that to the other members. As new members came in, they were young, I taught that to them. I said, it's always good to put some of this money that we get in wage increases into the pension. And they argued just like I argued. Oh, no, I need my money now. I got bills now. I have children now. But I said, you're going to really need that money at the end. You never know when you're going to retire. You might work to 60, 65, and that money will be there for you. And you always going to be able to use that money in retirement.
My last question is, can you tell us what your pension means to you and what would happen if Congress does not act to protect it? What do you stand to lose?
Well, I stand to lose being able to be independent and taking care of my family. I pay all my bills with my pension. If I lost it, I don't think I could go into another bakery and get a job at this point in my life. I'm 57. If the pension failed at 60, there's not too many people hiring 60-year-olds to walk into a bakery nowadays. So I probably would be out of work. I probably would have to go on social programs to make ends meet. It would be devastating to me and my family. So I need my pension to get by every day and do the things that I do for medical supplies, for medical prescriptions. That's another story altogether, but without that pension check, I'll be devastated.
Mr. Morgan, we all know Wonder Bread all across the country. And I want to thank you for being here today and telling us your story. It's heartwarming.
Thank you, Madam
Chair. It's
Chair.
an eye-opener for all of us in the committee and the people in the audience and all of our guests here today. And I want you to know that we're going to fight for you and the many others who are at risk of losing their pensions due to this crisis. And we, as Congress, will not stop until we get a solution. We promise you that.
Thank you so
Mr.
much.
Wahlberg and I are hand in hand. Promise you that. I now recognize the Ranking Member Wahlberg for his round of questions.
Thank you, Madam Chairperson, and thanks to the panel for being here. It's a worthy discussion we have today with no simple answers. I was hoping one of you would give that answer. Mr. Blahaus, the most recent PBGC data shows that for 2016, less than 2% of participants are in multi-employer plans that are more than 70% funded. On the other hand, 75% of multi-employer plan participants are in plans that are less than 50% funded, and 95% are in plans that are less than 60% funded. Do these statistics raise the possibility that even plans not projected to run out of money in the next decade or two will be unable to pay promised benefits over the long run?
I would say absolutely yes, and I think this is very important to understand because we throw around this figure of a $54 billion projected deficit in the PBGC insurance fund, and that's based on the projection methodology that they use. But there's a lot more underfunding over the horizon beyond what is reflected in that $54 billion figure. So no one should be laboring under the illusion that if we sort of stitch up and patch together a few particularly prominent or immediate problems in specific plans.
Central states specifically. Yeah.
I don't like to talk about specific plans, but right. I mean, there are certain large plans out there right now that are focuses of immediate concern. But the story's not going to end there. Unless you fix the underlying structural problems in the multi-employer pension system, that other $600 billion worth of underfunding, that's going to come to roost. And so this is not just a matter of patching things up and moving on. There's a fundamental structural worsening problem that has to be addressed.
So if we fix Mr. Morgan's issue, which we want to, you're saying that doesn't do it for many others as well, if we don't structurally do some significant changing.
That's exactly what I'm saying.
Okay, thank you. Professor Naughton, according to the most recently available PBG data, multi-employer plans are underfunded by $638 billion. That's a large number even around here. Putting benefits for over 1 million plan participants at risk. This is, of course, unacceptable. As we all know, the first rule of holes is to stop digging. As such, is new underfunding being created in these plans each year? And if so, is this new underfunding limited to yellow zone and red zone plans?
No. So every year there is new underfunding, but it is not restricted just to those plans. So the way the system is set up, the contribution requirements don't reflect the full economic value of what is being promised. So every year when a new benefit is promised to a current participant, there's some amount of just structural underfunding that goes along with that. And that's obviously, creates a bigger problem because when you sort of project things forward, where if you look at the last several years, every year the level of underfunding has gone up in the system. So it's not like if you look back a couple years ago, it was 800 billion, now it's down to 600. It's been going up every year, and the reason it's been going up is because the participants that are collecting are getting closer to retirement. Benefits are being promised to people that are not being funded. And this is sort of the cycle that we're on, and that's going to continue unless there's a complete change in how they're funded. And then, the other related point is, imagine there's another recession next year, what that would do to the funded situation in those plans. And that's why it's also important to take a look at how they're investing their assets to at least limit the damage that would come from these other types of external events.
Okay. Additionally, Professor, when multi-employer pension plans fail, are union and employer trustees personally liable?
Currently, they are not personally liable. So the trustees are fiduciaries, and there are situations where those fiduciaries have been sued by participants for not fulfilling their duties, by making very risky investments, by not collecting sufficient funding, but those have not moved their way through the court system yet. And at least statutorily, there's no official rule that would hold them
That they're liable. Do businesses and unions who jointly sponsor these plans both have liability?
They have potential liability. So there's no statutory rule that says they're responsible for things. When you look at the businesses, what they've agreed to, being part of the plan, is to be joint and severally liable for all of the underfunding. And so we've heard other people testify about withdrawal liability, but what it really means is you're the last firm standing. And so to the extent that it gets to that point where a fund goes insolvent, the employer is obligated to contribute towards the plan. And to the extent that they don't have the resources to actually cover the insolvency, then they're simply forced into bankruptcy. The example that Mr. Morgan presented with Hostess Brands is a case where there was a company that was liable and owed close to $1 billion, but simply didn't have the resources to actually do that. There was no money left. The people had already taken the money out of the company. So that's sort of what it. So when you look at sort of the structure of what could happen, the employers that are part of these plans could be forced into bankruptcy.
Thank you. I yield back.
Thank you. I now recognize Mr. Norcross for 5 minutes.
Thank you, Madam Chairwoman, and thank you for putting together this incredibly important hearing today, and to Ranking Member Wahlberg and Dr. Rowe, who and I have been working on a number of these issues for 2 years, and certainly to Bobby Scott, who we served on the Joint Committee. Pensions, that promise of a retirement that you put on hold through wages. Mr. Morgan, it's absolutely, these are wages, these are your dreams that you put on hold. We certainly understand that. The $12,870 a year, what do you do with that after you're making $30,000? Because this is money. There's so many issues surrounding this, and it can become complicated. But a couple of facts we know are going to happen. If we do nothing, the system crashes, and it takes down virtually everyone with it, sooner or later. We don't have an option not to do nothing. This is a disaster. We literally spend hundreds of billions of dollars a year when a hurricane strikes a state, an island, or elsewhere. It's not their fault, but we do that. This is what we do in America. When the banks were going under, what did we do? We saved them because it's good for all of us. When the auto industry, these are people's wages, and through no fault of their own, they're being left out to dry. This impacts all of us. We need to level the playing field. So we've heard from a variety of you, and I thank you for your testimony today. If it was as simple as some people are suggesting, this would have been done already. You can't just change assumption and have those healthy plans pay for everything else. This is a natural disaster that hits our country, and it needs a national answer. So as we go through this, there's a couple of things that are on the table, and I'd like to submit for unanimous consent, enter into the record compilation of the materials from memo described in our work with the Joint Select Committee on Solvencies and Multiemployer Plan. Without objection. Thank you. So we know if we do nothing, this crashes and burns. The Butch-Lewis Act is the one that we're talking about. I equate it to a person who's being rushed into the emergency ward. Unless we take care of him immediately, it dies. But we also want the system to continue to grow and get stronger. And that's what we had. The GROW Act was the composite plan. Because unless we fix the underlying issue, as many have testified, we're going to be back here, and none of us want this. We want to fix it for once and for all. So for Mr. Spencer, why should government get involved here?
Well, I appreciate the question because it's one we hear frequently, and I think the simple fact is that some of these plans are in such a condition that they're not coming back, as I said in my testimony, regardless of what interest rate assumptions they use, regardless of what investment options they make. they're not going to be able to recover without funding. And as you noted, there's really not a lot of great options here. We're sort of debating over the least worst option. There's always risks with these types of loans to plans. There's always the risk of a default, but you compare that to the risk of doing nothing, and I think as we've heard today, that risk is substantial and it's very real.
Because it will take down the private side. Those employers are there potentially are going under. And when they do shed their liability, which is one of the structural issues, is you can walk away. First position in bankruptcy are wages, so they get their last paycheck. But if you turn that in, wages into pension, they're in third position. This is why none of the money ever gets there once somebody goes out. They shed their entire liability. If we concerned it as wages, it would be up front, and we wouldn't be here today. It's one of the most major problems. I understand bankruptcy is a very difficult issue for companies because they want to return. But in exchange for their return, they left all the people behind you. They get to start their life over as a company. The people behind them have to pick up the pieces. And fundamentally, I just want to leave you with one thought. We're all in this together. Everybody is in this together. All 50 states have companies, have people on this system. We owe it to them because we made the rules that they're investing by. With that, I yield back the balance of my time.
Thank you. I recognize Dr. Rowe for
Thank you.
5 minutes.
Thank you very much. And I'm going to start, Mr. Morgan, by telling you a story. When I was in the Army in Southeast Asia in 1973, my dad's company, he was a union member, worked for B.F. Goodrich. His company moved south of the border. 30 years after World War II, he got a $10,000 buyout for his pension for 30 years' work. That's it. My family's been down this road. The problem that we have right here, it's basically an arithmetic problem. You got more liabilities than you have benefits. And the structure of the plan, I was on the committee with the chairman and with Congressman Norcroft. We've worked hard on this issue. I understand it probably as well as anybody in the Congress. You had a plan set up with multiple companies went in. There's a last man standing rule. The assumptions made on returns were way too high for many of them. At 8% on paper, they look pretty good, but that just wasn't reality. And so those assumptions are too high. They actually probably are more plans in the red zone than we know of right now. I think probably there are. And because of these assumptions that have been made, and you can make, if you get an 8 or 10% return, you can make your balance sheet look pretty good, except that's not reality. And there is no question going forward, we missed an opportunity in 2014 to put a composite plan or a hybrid plan out there to begin to allow companies to heal. I look at Schnucks and I see what a situation they're in. It's a very solid company. There are other people out here in this audience I know that are representing companies that are very solid companies, but have an incredible last man standing liability that exceeds the value of their company. And I may have heard this wrong, but we've got 3.8 million workers and 10 million retirees. The idea is you were going to continue to put more and more people in, sort of like Social Security was, except that what Mr. Morgan should have had was what he put in all these years should have been there just for him when he got out. And that's not how these plans were designed, and that's why we have to redo it. And before I forget it, I want to thank the NCCMP. They've been very helpful in educating me on this extremely complicated issue. So my question to you guys is this. Okay, we've got plans out here with these. I've heard all the assumptions about what will happen if we don't do something. There's been one plan, or maybe two, I heard in the testimony on the Senate side, that have ever paid a loan back. So how does it make it better when the federal government loans money to a plan that can't pay it back? If you can't pay your liabilities now, how does giving more money allow you to pay this back? Can anybody can take that one.
Well, thank you for the question. I think the answer is that it's not just the loan. Okay, so we've got 5 principles in our package that we put forward, which includes some other tools to help plans restructure, to help plans deal with some of the funding deficiencies, to help employees who are in the plans.
Mr. Spencer, help me right here. When you say restructure, put that in English. Is that to lower what you're going to pay Mr. Morgan? That's what he wants to know at the end of the day. Am I going to get paid what I thought I was going to get paid when I put it in? And is that what you're saying? Because that was one of the tools we gave in the 2014 plan.
Right. Under MEPRA, there were provisions for benefit suspensions. There were also provisions to allow plans to merge. There were provisions in there for partitions. So I think all of those tools need to be given some time to work in conjunction with loans. I think that's a better way to look at whether or not those plans would be able to repay the loan. There's always a risk of default. I mean, that's a given. We can't get around that completely, but there are ways to make it less risky for the taxpayers who, after all, would be putting the money
What
out.
are they? Because, again, I'm trying to figure out a plan that is these plans that are probably more than 600 plus billions. And that money is loaned at, say, 30 billion a year over 20 years. How do you pay it back when you can't pay your bills now? Because as Dr. Naughton said, we haven't rejected the economic cycle. There will be another recession. It'll come at some point. Maybe not in the next year or two, but at some point in time there will be.
Right. The way that we have envisioned this is with very low interest loans that, hopefully the plans will be able to make some of that back. But I think Mr. Blahhaus in particular talked about things like orphans. You've got to deal with that question of the folks who are in the plans that aren't receiving any employer contributions.
So what you're saying, you'll take this money, let's say we give a plan $1 billion, and they pay benefits with that, then they invest that money and hope to earn a higher rate than what they're supposed to pay back? Is that what I'm hearing you say?
Well, some of it would be invested. Of course, some of it has to be paid in benefits as well. But again, I think combined with the other tools that MEPRA provided and that we would envision as part of a plan going forward, there would be less of a risk of plans defaulting on those loans, but it's a risk that's there.
Well, I thank you very much, and I appreciate the panel. Y'all were excellent.
I realize the time is up.
Thank you very much.
I'm sorry.
I now recognize Representative Weil for 5 minutes.
Thank you, Madam Chair. Good morning to all of you, and I echo my colleagues' sentiments. Thank you for shedding so much light on this very important subject that affects workers across our country, certainly in my district, and I know in all of my colleagues' districts. I wish Congress didn't have to get involved in this problem. I wish employers across the country would honor their obligations to employees, as Ms. Moorkamp, Schnuck Markets has over the years. I understand from what you've told us that Schnuck has faithfully paid its pension obligations consistently since 1958, I believe. I wish all employees would do that rather than executives essentially stealing from their employees by granting themselves big pay raises at the expense of their employees' futures and their retirement. And I know that's what happened, Mr. Morgan, at Hostess. Your written testimony was very compelling on that regard. It's my understanding, sir, that you were 33 years with Hostess and that in 2012 it closed its doors. During all that time, you worked on a full-time basis, sir?
Yes, I did.
And it was a physically demanding job, is that correct?
Every day.
And did you personally get involved in discussions about negotiating pay raises in favor of pension contributions?
Yes, I did. I was also a member of the negotiation team, and every negotiation that we had, we would talk about pay raises, and then we would go right to pension benefits. Some of the pay raises would be 35 to 40 cents. Out of that money, we would take probably 12 to 13 cents and buy additional pension money.
And those additional purchases of pension money were done by the employees themselves, correct?
Absolutely.
That wasn't by the employer?
No.
Because
no.
of the
that came out of our pockets.
Because of your interest in securing your retirement.
And making the levels higher.
Understood. And did I understand you correctly that with the pension that you currently get, Mr. Morgan, you are able to pay your bills?
Yes.
You're not getting rich, is that fair to say?
Not getting rich.
But you're able to pay your bills?
Yes.
And if you were to lose your pension, would you need to rely on government assistance of some kind?
Absolutely. Absolutely. I would try to get more jobs. I would try to apply for jobs. But when you in your late 50s, early 60s, how many employers are going to hire you? Mm-hmm. You struggle with that. but every day I got to pay bills.
And are you currently working part-time or otherwise?
Yes, I work a part-time job at a school.
Okay, is that to supplement your pension income?
Yes.
Would that part-time income that you have at school suffice to pay your bills? If
Oh,
you were to
absolutely.
lose,
Absolutely.
if you were to lose your pension?
That can pay my bills.
Okay. And would you just describe for us what your employer told you in 2011 about an interruption to pension contributions that was happening?
Well, they wanted a break from paying the money into the fund. And our union decided, let's try to help this company the best way we can by giving them some kind of breaks and payments. But when they did that, Hostess was never interested in repaying that money. And then they filed federal bankruptcy, then they walked away. They didn't have to pay it anymore after that.
All right,
we worked 2 years before the plant closed without them contributing to the pension fund.
Thank you, Mr. Morgan. Dr. Naughton, I just want to address the situation that Mr. Morgan just described. In the case of, you had mentioned in your testimony before that when this happens, the people had already taken the money out of the company. You weren't specifically referring to Hostess, but companies in general that were not able to meet their pension contributions, correct?
Correct. If you're going to end up in bankruptcy, it's usually because there's no money left in the company.
And when you say the people, you're not talking about the workers took money out of the company, are you? You're talking about the people who bail on the company when the times get tough, right?
So I don't know who the exact person is in each situation, but in general, when a company runs out of money, everybody suffers.
And this is something that can repeat itself over and over and over again
Absolutely.
in the future.
Yeah, and
is that right?
you can guarantee that there will be companies over the next several years that are in these plans that are going to go bankrupt and have the same series of events occur.
Thank you. I yield back.
Thank you. I now recognize Mr. Allen for 5 minutes.
Thank you, Chairwoman, and thank you for sharing this information with us. This is my third term. I was here, I think, my first year, 4 years ago. We sat in a similar meeting, and it looks like we made little or no progress, and a lot of promises were made and not kept. Obviously, Congress, we're here today to listen and learn and be a part of trying to solve this crisis. I believe any proposal must have, some structural reforms that, and rather, a Band-Aid approach is just not going to fix a hemorrhaging problem. And of course, we got other issues. We have $22 trillion in federal debt. So for us to sit here, and we're managing that, supposedly, and for us to sit here and say we're going to solve your problem is troublesome, because some people say it might take 400 million years to pay off that debt. So whatever we do to fund these retirement programs, how many generations is that down the road that are going to pay for it? Amazing to think about, isn't it? In other words, our children's 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 children will pay for whatever we do to try to fix this. And I don't think they're going to be real happy with us. But Dr. Naughton and Dr. Playhouse, do any of the solutions that are on the table today or have been discussed over the past few years actually do anything to solve the pending pension crisis, and have these proposals included any structural reforms? In other words, we know we got a problem. Is there been anything done to fix it?
I do think there are some positive models out there for reform. One of them is the 2006 Pension Protection Act, what was done on the single employer side. That was very tough and difficult, arduously negotiated legislation. But it did succeed in stabilizing what was then a burgeoning problem in the single employer system. And I think there are a lot of important lessons that could be drawn from that to address the multi-employer system. If you're asking whether I have seen specific legislative proposals over the last year that would fix the multi-employer problem, I have not. I mean, there were various outlines that were floated around. I don't think they would have succeeded in solving the problem. But then again, this is a very difficult problem to solve. And go ahead.
Without legislative, I mean, in other words, we know companies come and go. And we know that people move from company to company. You know, thank goodness we're in a growing economy right now, one of the best, maybe the best economy in the world, which is one of the ways we're going to get out of this mess. But given the current situation, in knowing that companies are going to come and go, that you still have multi-employer pension plans, what are we doing right now to fix this going forward without anything that Congress would do?
Yeah, I think the hard truth is it's not going to be fixed without legislative action. I do not think the crisis can be averted without legislation, without federal legislation. I think the problem is too large and too immediate, and the problems are too vast. Problems with the funding rules, problems with measurement inaccuracy, problems with the orphan workers. I do not see the system righting itself without federal legislation.
Any kind of idea on the impact? Obviously, we're growing at 3% maybe right now. We'd like to see greater economic growth every time. I mean, when I get up in the morning, I think about economic growth, create jobs, because again, that's the only way we're going to get out of this mess we're in. What's going to be the impact? Anybody have any idea what the impact on the economy is?
Well, I would say economic growth helps.
Yeah.
But you have to bear in mind.
But if something's not done, what is going to be the hit to the economy? Do you have any idea?
I'm sorry?
What would be the actual hit to the economy if we said, hey, this is your problem.
Right.
We got other problems we got to deal with. What's going to be the hit?
To try to quantify it, it would be, I think, it would be very substantial. I think the point I would make is that a growing economy by itself is not going to fix this problem.
Right.
With legislation.
It helps. You got more people paying in. Okay.
We've had a recovering financial markets for the last several years, and yet the funding ratios in multi-employer plans have actually declined.
Right.
They've gone from 50% in 2011 down to 43% in 2015, and that was with the financial markets recovering. So we need to do more.
I'm right at time, Mr. Morgan. You're a great American. Thank you for your years of service, sir.
Thank you. I recognize Representative Stevens for 5 minutes.
Thank you, Madam Chairwoman. I wish to enter 3 letters into the record. 2 are from AARP and the Teamsters, which has a significant presence in my district in support of H.R. 397. And the other letter is from the Council for Citizens Against Government Waste, which, while we don't agree on everything, highlights the critical importance of solving the impending multi-employer pension crisis in a bipartisan way, something that I believe this subcommittee, under Madam Chairwoman's leadership, can achieve.
Without objection, so ordered.
Thank you. Thank you. I would like to note that this issue hits extremely close to home for me. Central States, which, as we all know, is about to be insolvent, covers tens of thousands of workers in my state, including almost 3,000 people in my district alone who are covered by 102 employers. I'd like to also just recognize the tremendous leadership of the Teamsters and their friendship to many on this committee and throughout southeastern Michigan. And I would like to recognize every labor union tuning in today as we as a committee seek to bring your issues to the fore and as we project a vision of the future and value of work vis-a-vis a 21st century labor movement. We find ourselves in a new moment, in a new Congress, in this committee. Doing nothing means plans will fail, businesses will fail, employees will get zero of what they have earned, and taxpayers will end up paying for it. Insolvency is not an option, and it doesn't have to be. I am a proud co-sponsor of H.R. 397, the Butch-Lewis Act. This bipartisan legislation would shore up pensions that are facing insolvency already, and those that are facing insolvency in the very near future. CBO, as we know, has estimated that this will cost between $34 billion to $100 billion. So, Ms. Becker, I'd like to turn to you and just ask, what would be the total cost to taxpayers over the next 10 years, accounting for both lost tax revenue and social safety net programs if the multi-employer pension crisis is not addressed?
So absolutely, thank you. That's a great question. And as we were talking about before, when these plans fail, there will be a cost to the government, and it will encompass both the lost tax revenue and the social safety net spending that will happen when these the participants in these plans lose their benefits. So on the 10-year window, it sort of depends on how much you expect these participants to be able to recover those jobs and those wages that they will lose when the employers go bust. But it is somewhere between oh, I apologize. I flipped my page. It's somewhere between $170 billion and $240 billion in total between the tax loss revenue and the increased social safety net spending.
Thank you. And Ms. Becker, by your organization's nonpartisan data-informed estimations, wouldn't the overall cost of doing nothing be far greater to taxpayers than the cost to implement H.R. 397?
So the cost of doing nothing is likely to far outweigh the cost of any action that the government takes to avert this crisis. The faster you can act, the less expensive this is going to be to fix the problem.
Thank you. I yield back the remainder of my time.
Thank you. I now recognize Representative Taylor for 5 minutes.
Thank you, Madam Chair. Appreciate that. This is clearly a very serious problem, and I appreciate the testimony we've heard here today. One thing I do understand is if you charge an actuarially unsound premium for an insurance product, eventually its actuarial unsoundness will come to roost, right? So if you charge $100 for something that costs $600, they're not putting enough money away to actually cover the risk that you're trying to cover, and then we're in this hearing, right? And so, Dr. Blauhaus, can you just expand on that in your testimony? Because I think you spoke to that. I think I got the numbers right, 1 to 6, but.
Well, that's right. In fact, I think the 1/6 premium, the fact that premiums per capita on the multi-employer side are 1/6 per participant what they are on the single employer side, I actually think that understates the problem that you're talking about, which is that in order to be actuarially fair, an insurance premium has to recognize the risk of payment, the risk of failure.
Sure.
And right now, we have a single employer system that is basically stable. The last PBGC report found no net deficit in the single employer insurance program, but there's a $54 billion projected deficit in the multi-employer system. And yet the multi-employer system is charging premiums that are much, much lower than they are on the single employer side. So there's the magnitude issue, but there's also the design issue. On the single employer side, there's a flat rate premium. There's also a variable rate premium. The variable rate premium is assessed on underfunded plans to recognize the additional risks they pose to the insurance system. You don't have a similar animal on the multi-employer side, and so, in effect, sponsors of funded plans are basically subsidizing the risk to the system that is caused by underfunded plans, and the insurance system is not able to charge anything close to the appropriate premium that recognizes that risk of underfunding.
Sure, so just to restate what I think you just said is that if you're not charging the actuarially sound premium, it will be actuarially unsound. I mean, that's just, it's almost tautological in a sentence, but I think it's just factually correct. And then in terms of you're talking about a risk premium. So if an employer is underfunding their payments into their pension fund, there's not a penalty assessed in terms of the risk premium. In other words, if you think about auto insurance. A riskier driver, someone that's had many accidents, is going to pay a higher premium than someone that's never had an accident because the insurance company adjusts based on risk. So in this case, you have a pension plan which is underfunded. There's no additional premium on the multi-side, but there is on the single side.
That's correct, and I think this speaks to a larger question of moral hazard in the system, which is, we've had a lot of very good discussion here about, this is basically compensation for workers, right? Like wages or in lieu of wages. These are benefits that workers have earned. But at the same time, it is a lot more pleasant situation for employers and union representatives alike if there are additional dollars on the table available for wages rather than having to put that money in the pension plan.
Sure.
And so that creates a lot of moral hazard to shift the risks of underfunding to the insurance system, to other employers and other workers. And the only way to counterbalance that moral hazard is to make sure that there are rigorous enough standards for funding, rigorous enough insurance assessments, and rigorous enough safeguards against digging the underfunding hole deeper. Otherwise, you see the incentives that lead to the grossly underfunded situation that we have today.
And just to state the obvious, the sooner that Congress acts to make an actuarially sound premium setup, the sooner, the less damage there will be to actually have to dig out for the future. Is that a fair statement?
Right. I think there's two levels here. One is the solvency of the PBGC insurance fund, and the premiums speak directly to that. Now, you have a larger underfunding problem out there beyond that, and so there are risks to workers whose benefits have been promised in excess of the PBGC insurance guarantee that arise from larger underfunding in the system. But the first order of business, if you interpret that as stabilizing the PBGC insurance fund, certainly requires a reformed premium structure.
All right. Thank you, Madam Chair. I yield back the balance of my time.
Thank you. I now recognize Representative Fudge for 5 minutes.
Thank you very much, Madam Chair, and I thank my colleagues for allowing me to go out of turn. Thank you so much. I'll be very brief. First, I'd like to ask unanimous consent to enter into the record a letter from the Bakery and Confectionery Union and Industrial International Pension Fund, which proposes a long-term low-interest loan solution as has been discussed here.
Without objection. So
Thank you. And I just want to say two things. It's interesting that people who have worked 30 years, whether it be a pension or Social Security or Medicare, we always have a problem with trying to find a way to find a solution for these people. If we make them a promise, we ought to keep it. I think sometimes we forget as members that our real job here is to take care of the people we serve. It's not to save money. It's to take care of the people who sent us here. And so I would suggest very strongly that instead of spending $5 billion on a wall, we put it into the pension fund. Let's put it into PBGC. I think it's important that we do that because it is more important to me to take care of the people who work for this country than it is to build an unnecessary wall. Madam Chair, I yield back.
thank you. Who's next? I now recognize Mr. Watkins for 5 minutes.
Thank you, Madam Chair, and also thanks to Republican Leader Wahlberg. My question is for Dr. Blouse. Now, it seems to me that many of our workers, particularly our millennials, are paying into pension plans that will become bankrupt. So perhaps an alternative solution could be that they receive less of what they have accrued in the pension plan and be allowed to contribute to a 401k or an IRA, something that they would own. What are your comments on that?
Well, I certainly agree with the point that the sort of historical defined benefit structure in many systems is not serving the interests of younger Americans very well. Andrew Biggs has done some excellent research on this for us at the Mercatus Center, but basically sort of surveyed the defined benefit landscape, and you find underfunding wherever you look. You find it in the multi-employer system, you find it in state and local pension plans, you find it in Social Security. In comparison, the defined contribution system, while it has its shortcomings, is performing comparatively better. And it also is less sensitive to demographic shocks, because if you're, in a sense, pre-funding your own future retirement benefits, that type of system is less sensitive to a change in the ratio of contributing workers to retirees. So I certainly take your point. I think there have been proposals that have been put forward by Rachel Gressler, basically to sort of let people sort of buy out of the system in a way. Now, they would get less than they are currently being promised by the multi-employer pension systems, and you wouldn't be able to give them everything that they were currently promised. But if people were willing to take a haircut on that benefit in order to receive a certain form of it, you could transition them to a defined contribution type of system.
Thank you, Doctor. Thank you, Madam Chair. I yield back.
I now recognize Mr. Levin for 5 minutes.
Thank you, Madam Chairwoman. I'd like to start by thanking all the witnesses for your testimony and participation today. And in particular, it's enlightening to hear the real lived experiences of companies and workers from Ms. Moorkamp and Mr. Morgan. It's extremely helpful to us. And I notice a lot of folks in the room here, too. I know Brother David Durkee from the BCTGM is here. I saw mine workers, steel workers, Teamsters, and others. And I really appreciate you folks being here. The fundamental point about pensions is that they're not charity, they're not a donation, they are money that workers put aside themselves in cooperation with their employers so they could have a dignified retirement. They own it, it belongs to them, and shame on us if we don't help them have that in their retirement. Madam Chairwoman, I'd like unanimous consent to introduce 4 documents into the record. A letter to the chairman of our committee from Anthony Perrone, the president of UFCW, a letter from Robert Martinez, the president of IAM, a letter from Leo Gerard, the president of the Steelworkers, and a statement from the Steelworkers on the pension crisis.
Without objection.
Thank you very much.
Ordered.
Thank you. I'd like to ask you a question, Mr. Blauhaus, about the use of corporate bond rates. I need to understand this better. I believe you advocate using corporate bond rates to discount multi-employer pension liabilities. And currently, those discount rates are very low because we're in a fairly low interest rate environment still. But would you also support discounting those liabilities at 9% or 10% when interest rates rise, as happened in the 80s?
I do think they should float, yes. Wherever corporate bond rates go.
Wherever they go.
Wherever they go.
And do you acknowledge that there's year-over-year volatility in the corporate bond market, so the problem may get worse if and when interest rates rise?
Great question. The volatility question is really important, and I appreciate your asking it because this was a sticking point in 2006 when we were debating correct discounting for the single employer system. And the concern, predictably, was that using accurate discounting would lead to unwanted volatility and contribution requirements. And my strong recommendation is, I think it is important to dampen required contribution volatility, but I would not do it by distorting the measurements, by distorting the discount rates. I would do it by brute force limitations on annual contribution volatility, because the funding rules, the contribution rules, that is something that you might need to massage to get to where you want to go in terms of policy. But I would not try to dampen volatility by distorting the measurements, because the liability is simply...
All right, well, let me ask you a question then, Ms. Becker. What impact do you think changes in the funding rules would have on healthy plans? That's a concern of mine.
So if we change the discount rates or the funding rules that apply to the healthy plans right now, it would have really dramatic consequences, both on the participants in those plans and on the employers that participate in them.
Positive or negative consequences?
Absolutely negative consequences.
So can you explain a bit?
Yeah, please. When we looked at this previously, we took a look at a couple of different example plans for what might happen if you go ahead and change the discount rates. The most immediate and obvious consequence, which I think was referenced a little bit earlier, is that the contribution rates are going to go through the roof for the same level of benefits. So an example plan where contributions were right around 22% of pay, that is a substantial contribution that is going into fund retirement benefits. Those would at least double. So you would be looking at somewhere between 46% of pay and 60% of pay to fund the same benefits into those plans. I don't know, perhaps the employers on the panel can speak to whether a 60% of pay contribution rate to fund benefits would be bearable or not, but my impression is that that would be strenuous. When you look at that, that is not even resolvable. It would be easy to say, well, okay, so these plans need to stop offering benefits going forward, and that will resolve those contribution requirements. You won't have to pay for more benefits. You just have to pay for what you already put into the plan. For these plans, that is not a possible solution here. Even if you were to freeze accruals going forward, you're still looking at contribution requirements that are somewhere between 30 and 40% of pay.
All right.
Again, I would turn to the employers and ask whether that's bearable.
Well, thank you. My time's up, but I would just make the point that we need to solve this crisis now, as you've all said, but I just want to make sure that our solution solves it and doesn't make it worse down the road. Thank you, Madam Chairwoman. I yield back.
I recognize Representative Johnson for 5 minutes.
Thank you, Madam Chair. Dr. Naughton, you mentioned in your testimony, you used the annuity analogy, talking about, I think that these plans in general need a lower risk profile. I was a little surprised by that. I used to be Chief of Staff to the Governor in South Dakota, and we take a lot of pride in our state employee retirement system. And that doesn't have that kind of exceptionally low risk profile. Of course, it's got a broad-based and mixed portfolio, but quite heavy in equities. I mean, our plan is more than 100% funded, and I think weathered the recession reasonably well compared to most. So maybe flesh out your comments a little bit. I would think it would be very hard to deliver any kind of a real return with an ultra-low risk approach.
That's a great point. So when you look at pensions generally, there is sort of this belief that we should have a diversified portfolio. And the idea of following an approach where you can take equity risk, a requirement is that you can absorb the downside of that equity risk. So if you're a state that has a lot of sources of revenue, you can increase tax receipts in the future, whatever is to fund it. If there's a negative period, you can respond to it. If you look at the single employer system, a good example there would be General Motors, where in 2003 they issued $10 billion worth of bonds and put the money in the pension plan. So they were invested in equity, there was some down years, and they responded by putting more money in the plan. What's unique about multi-employer plans is they don't really have the same ability to go back and get contributions because there's many participating employers, and over time those participating employers come and go. One of the items that's been raised today is when you look at the plans that are in the worst condition, it's the ones with orphan employees, because those are the ones that are, amongst all of them, they're the ones that are least able to go back and get additional contributions. So when you look at the multi-employer plan system, the way it's set up, if you were to ask Mr. Morgan what he thought he was getting, he would say, I was promised a retirement benefit. When someone promises you something, they don't put the money in the stock market. They put it in sort of a low-risk annuity type setup. And so that sort of is the fun of this disconnect here is the trustees of the fund should have sort of recognized that there's a lot of inability to go back to get more funding. There's a lot of inability to weather the downside. If we happen to have a really good year, what the multi-employer plans tend to do is they increase benefits. They couldn't be overfunded. And so structurally, there was no way to respond to equity risk. And so if you think about it logically, they shouldn't have been taking it in the first place.
I mean, isn't this just a math problem? And we've had a lot of discussion about discount rates, and that all makes sense to me. But we know, it seems like if you really want to be actuarially sound, you're going to estimate that a certain number go bankrupt, and you're going to estimate that there'll be down years, because there are always down years, and that you should be able to weather those storms if you make reasonable and conservative assumptions. Isn't that right?
Yeah, that's correct. But that's not what these plans did. I mean, what they did, if you look at, your own individual retirement. All of us, when we're young, we invest in equities in our own 401ks. When we get older, we switch it to low-risk fixed income because we're concerned. When you look at the multi-employer plans, the vast majority of participants are older. And that by itself would tell you they shouldn't be investing in these risky securities.
Yeah, that makes a ton of sense to me. So now, Dr. Blouse, you mentioned a statistic. You said 1/6 of something, and I tried to catch it, and then I tried to look in your written testimony. But I thought I heard it right, but it seemed hard to imagine. So can you repeat that?
The average premium payment on the multi-employer side is 1/6 per capita what it is on the single employer side, although the insurance program deficit on the multi-employer side is much, much larger. In fact, if I could dramatize it still further, last year...
That's pretty dramatic, though.
That's pretty dramatic. About $5.5 billion in premium revenues were collected from single employer sponsors last year. It was about $300 million for multi-employer sponsors. And yet the single employer system is not in deficit, but the multi-employer insurance program is facing a $54 billion deficit.
So that's a pretty substantial policy failure.
It's a
for premiums to be set that low.
Not only the magnitude of the premiums, but the design. The fact that there's no variable rate premium for underfunded plans on the multi-employer side.
I mean, I understand why some of these contribution things are set through collective bargaining arrangements. I assume that the infrequent nature of renegotiation complicates how nimble these plans can be in adjusting to actuarial liabilities.
Well, I would say that the problem is even more severe than that, because remember how these plans are designed in ways that are different from the single employer system. In the single employer system, you might have a set of benefit promises, and then if you make actuarial assumptions that are too aggressive, you might not put as much funding in as you should. But the multi-employer side, as you said, it's built around a collectively bargained contribution rate. So if the trustees then go out and use unrealistic assumptions to build the benefit structure, the benefit promises themselves are inflated because of the use of aggressive discount rate assumptions. So you have a situation where the Board of Trustees is making more benefit promises than the contributions can fund, and then getting in trouble and wanting assistance.
Thank you, Madam Chair, for your additional courtesy.
Thank you. I now recognize Representative McBath for 5 minutes.
Thank you, Madam Chair, and thank you so much for convening this hearing, and thank you to the witnesses that are here this afternoon. In my district, UPS has its world headquarters. That is the 6th Congressional District of Georgia. And they employ around 15,000 people across Georgia and roughly 399,000 people across the United States. UPS also contributes nearly $2 billion per year to 27 different multi-employer pension plans. So I know how important this issue is to a major employer in my district. Last year, UPS testified at a hearing conducted by the Joint Select Committees on the solvency of multi-employer pension plans. And Madam Chair, I ask unanimous consent to enter UPS's testimony into the hearing record. Thank you. I note for the record that UPS made a similar point that I'm hearing today from many of our witnesses. The cost of PBGC's failure will be extraordinary and will result in a lost tax revenue and higher demands on federal, state, and local government safety nets. UPS also makes the point that changing the actuarial assumptions used by multi-employer plans to be closer to what the single-employer plans use would make the crisis even worse. I'd like to ask Ms. Becker, do you agree with UPS that changing the actuarial assumptions would make the multi-employer pension problems worse?
Absolutely. So if you go ahead and change the discount rates, you are going to drive many of the plans that are currently in good financial health into one of the zones and into poor financial health.
Thank you. And can you please explain how it would get worse?
So when you change the discount rate, you are forcing plans to, rather than taking a very long-term look at how these benefits are earned and how they are going to be paid out, you force them to take a look only at what they expect to happen over the very short term in the markets. And when you do that, when you drive plans into the zones, which is what you will do there, you're going to force dramatic increases in the contribution rates onto employers, or you're going to force dramatic reductions in benefits on the participants, or some combination of those two.
So could this change increase UPS's contributions and potentially impact other plans in which UPS contributes?
Absolutely. So that's something that we mentioned a little bit earlier. That's something that Mr. Spencer mentioned as well, is the idea that multi-employer plans are very interconnected. Employers that participate in multi-employer plans don't just participate in one multi-employer plan, they participate in 2 or 3 or 5 or 10. So when there is and something that impacts the financial health of one of the employers that participates in those plans, that is going to, depending on the financial health of the employer where it starts, that is going to make it harder for them to continue to contribute to other multi-employer plans that are out there. So as you impact the financial health of a given employer or a given plan, you're going to impact the financial health of many other multi-employer plans in the system.
Thank you very much. And Ms. Becker, I really do look forward to being able to work with my colleagues and advancing a bipartisan solution. It's so well needed. This is a crisis, and I hope that we're able to work together in a bipartisan way to manage this crisis going forward. And I yield back the balance of my time.
Thank you. I now recognize Representative Muser for 5 minutes.
Thank you, Madam Chairwoman. Good afternoon. The plan participants that we have here, the workers, the Mr. Morgans of the world, certainly deserve none of the blame for this grossly underfunded pension plan problem that exists. Yet they are the ones facing the dire consequences, which is an unacceptable outcome. This, in my view, is another example of the false promises of defined benefit pension programs. Mr. Shapiro a little earlier mentioned, as he was defending the plan, that there were only 1 million people that could lose everything. Well, 1 million people is a catastrophe. And blaming 2008 market crash to be the core of all this, the market has recovered, as we all know, over 80% from its highs before the crash. So that well exceeds the 7% or so annual growth actuarial rate that's used to determine where the fund should be. So all that being said, Mr. Spencer, you outlined in your principles of reform in your testimony the last two. You wrote, while the PBGC may ultimately need more money in the form of increased premiums, these increases must be evaluated after tools to restore the solvency of these plans are put in place. And you followed that with composite plans must be authorized so that healthy multi-employer plans can stay that way. Can you be specific and offer some ideas here?
Sure, thank you. With regard to the healthy plans, our objective is to help them stay that way so that we're not back here again in a couple of years talking about the same issue. So with a composite plan, the idea is that you would take the folks that are in the existing DB plan, freeze accruals, and kind of wall that off, and then allow other employees, well, those same employees too, that are in the current plan to be part of the composite plan. And the plans must be funded at 100%. Some of the tools that were in MEPRA would also be applied to those plans so that the plans would not find themselves in an underfunding situation. But key is that they are also privately managed, right? There's no need for the PBGC to backstop the composite plan. So some of those types of tools, some of the other tools that are in MEPRA, particularly partitions, mergers, where needed benefit suspensions, ought to be applied to these plans going forward so that, again, we don't wind up back here in 2 or 3 years talking about some of the plans that are now healthy that would find themselves in an unhealthy condition.
Well, thank you. Well, I certainly look forward to working with our colleagues and coming up with some solutions for the people. Madam Chair, I yield back my time.
Thank you. I now recognize Representative Trahan for 5 minutes.
Thank you, Madam Chairwoman. Thank you. Thank you all for coming. Mr. Morgan, I don't actually need to ask you anything because when I look at you, I see my dad, a retired union iron worker, someone who, like you, worked physically hard every single day. He's battling MS right now in retirement, and I often think, especially when I'm sitting on this committee, that if his pension and if his benefits were not in place for him, it would bankrupt our entire family. So I understand this hearing is to address the cost to people like you if Congress, if we do nothing. And I can only imagine the anxiety, the economic anxiety that you have thinking about or calculating the consequences of us doing nothing. I appreciate all of the prescriptions that have been recommended to us here today for the future on how we might restructure defined benefit programs going forward. But protecting Mr. Morgan's dignity and the 10 million others like him requires immediate action. Would everyone agree with that comment? Okay, I guess I'm curious because is there anyone on the panel who does not think that federal assistance is required right now to stabilize the PBGC? Terrific. Everyone agrees that inaction is not an option. So that's helpful. I did want to ask a question to Mr. Shapiro, because you mentioned a number of factors as contributing to the decline of multi-employer plans. Maturing of plans, the lopsided ratio of retirees to workers, deregulation of trucking and other industries has added to this decline. Union rights have been under attack, the rights to organize, the collective bargaining rights across our country. They play out in state legislatures and in our Supreme Court. What impact has declining union membership had on the system?
Well, thank you for the question. It's made it harder for plans to recover from other factors that cause downturns. And I just want to go back to a comment that Professor Naughton made earlier, which is, you take risks when they can be properly managed. I paraphrase that, but that's how I wrote it down, which I couldn't agree with more. And if you look back at the past 15 years at the tremendous declines that have occurred in the stock market in the earlier years, the fact that the majority of plans have been able to get through that reasonably unscathed speaks to the fact that the system is pretty resilient when it comes to managing risks. But clearly, for an important and large segment of the population, those risk absorption mechanisms were insufficient, and that's why we're in the boat that we're in. So those trends that you mentioned are those that have kind of led to these plans being less able to absorb that risk. And as we look to go forward, I think the focus should be on making sure that balance is restored, that the risks that are taken and the ability to absorb risks are realigned, because at the moment they're not, and that's what led us to this current situation.
Thank you. That's helpful. And Ms. Becker, there's certainly structurally going forward, this is a tough issue, it's a complicated issue, and I think it's one where we're going to think hard about the prescriptions going forward. I'm wondering if you can share your analysis on why some multi-employer plans are healthier than other plans, and what characteristics or features do some of these healthier plans share beyond what's been proposed at the table today.
Sure. So I think Mr. Shapiro touched on many of them much earlier, a little bit earlier, which are the decline in the membership in the plans is tilting toward a imbalance between retired participants in the plan or inactive participants in the plan and active participants who are continuing to contribute to the plan. That tilt in that imbalance there is, result of, some of the things that you had mentioned in terms of the decline in union membership, but there's, also things that the government has done that has forced the hand in terms of driving that imbalance as part of the participants who are here to contribute to the plan itself. So, that's, and they're the things that you hear, fairly often. So trucking deregulation or, the decline in the active participants or driving employers out of the system, all of those things make it much harder for these plans to recover going forward.
Great. Thank you. I'm almost out of time, but it does seem to me that, we're going to talk about, the financially how defined benefit programs should be set up so that it mitigates that risk. But in my observation, we have done more to hurt the membership of unions that has been a contributor to this problem. As someone who grew up in a family that benefited from those union values, from the fact that it is the backbone of our middle class, I think we should be doing more to strengthen that unionship, certainly not inhibiting it. So thank you all. I appreciate it.
I now recognize Dr. Fox for 5 minutes, the esteemed Dr. Fox.
Thank you, Chairwoman Wilson. I appreciate that very much. Professor, thanks to all the witnesses for being here, by the way. Professor Naughton, when determining contribution amounts to a multi-employer plan, do unions and employers aim to fully fund the plans, or do they instead aim to meet the minimum contributions required by their respective collective bargaining agreements? And do you believe contribution levels are sufficient to provide plan stability?
In general, those negotiations focus on the minimum contribution. So just like a credit card, if all you ever do is make the minimum payment, eventually that balance is going to get out of control. When you look at sort of, how it should work, ideally you give companies the latitude to make the minimum so that during certain times they can make smaller contributions, during certain times they can make larger contributions. And that's one of the great benefits of defined benefit plans is you can kind of adjust the contributions to match the economic cycle and what's available. But in this case, that's not what happened. What happened is it's simply been the minimum almost every single time.
Yeah, that is very unfortunate, and your analogy to a credit card bill is excellent. Dr. Blauhaus, factors such as industry innovation, shrinking numbers of active workers, and economic downturns might negatively affect the multi-employers plan's funding level. Are these factors predictable, and what can plans do to prevent their negative impacts so that pension promises which are made to workers can be pension promises which are kept?
Well, I would say that some of these factors are more predictable than others. Certainly, sort of the long-term demographic and aging trends are relatively predictable. The fact that there will be, at some unforeseen time, financial market shocks is predictable, and prudent pension management would anticipate this. I think this is very important because it's undoubtedly true that industry changes, declines in the percentage of active workers, all those things have been negative stressors for the multi-employer plan universe. But they are not what has led to its uniquely underfunded condition relative to the single employer system. If you look at the percentage of active workers among total plan participants, it is just as low in the single employer system. That system has undergone the same financial market shocks. The differences are two. One is the set of funding rules and measurement rules that apply to the two systems and premium rules. They're just simply inadequate on the multi-employer side. And the other is the unique phenomenon of the orphan workers. Single employer plans don't have to deal with that orphan worker problem. And there is where I think is the strongest case for federal intervention because federal policy is to some degree responsible for that. But those are the two main factors. This has not been driven primarily by financial market shocks or changes in industry.
And I'm glad you mentioned this, the issue of federal intervention that my colleague asked about. I interpret, I believe probably different people interpret that phrase federal intervention different ways. You talk about policy and the way we can change the laws. I believe that my colleagues believe bailout when they talk about federal intervention. And while you all said, yes, okay, federal intervention can help, I believe we need to get on the record, and we'll talk some more about that after the hearing, that it's not just a bailout of these plans that requires federal action. Dr. Blauhaus, I'd like to ask you another question. For 2019 annual PBGC multi-employer program premiums, which are set by Congress, are $29 per participant. Historically, these premiums have been much lower than $29 per year. In its 2018 annual report, PBGC stated it has a deficit of $54 billion. In your opinion, are PBGC premiums set at appropriate levels when compared to the risk PBGC assumes when it insures multi-employer pension plans?
Well, if I could preface my answer by first expressing my agreement with your previous point, that I do not believe that just the injection of federal subsidization of this system, whether it's packages, loans, or otherwise, is going to fix that problem. So I want to be very clear about that. But I do think the premium structure is inadequate, both in magnitude and in design. The premium assessments are not sufficient in amount to finance the potential claims on insurance coverage, and they're poorly designed in that they do not recognize the risks of underfunding.
Thank you very much. Thank you, Madam Chairwoman.
Thank you. I recognize Representative Morrell for 5 minutes.
Good afternoon. Thank you, Chairwoman Wilson, for holding this very, very important hearing, and to all the witnesses for being here today. I had a chance to review the submitted testimony. I'm grateful we're taking time to understand the causes of the multi-employer pension crisis and meaningful solutions. I've heard from many constituents and other stakeholders throughout the last several months and recognize the severity of the situation. There's been much discussion. I note that, like the gentlewoman from Massachusetts, my father was a member of the Pipe Fitters Union, and so a multi-employer pension system has been very important to him. He passed, and it's very important to my mom. There's been a lot of discussion in recent years about retirement security and how we ensure hardworking Americans can retire confidently and with the peace of mind that they don't need to have a part-time job to get by once they retire. And amidst the heightened awareness of retirement security, growing concern and shifting of responsibility, an undeniable fact is that we have made a promise to American workers about the sustainability of their retirement, and they have the most to lose if we do not find a viable solution here. I want to thank Mr. Morgan, particularly taking time to share your story. I read your testimony, was struck by your statement that you negotiated and fought for your pension because it meant you'd be able to retire with dignity after a lifetime of very hard work. And I know from my dad's experience how hard he worked every single day of his life. At the end of the day, that's what we all want. We pay into a system with a promise we can retire with dignity, and we deserve what we've earned. So I appreciate your testimony. I believe it would be our utmost goal to protect the employees who paid into the plans, obviously also for the employer groups who have contributed as well. And I hope this hearing brings heightened awareness and attention to the severity of the situation. I'd also like to acknowledge that as we find solutions, we should safeguard healthy and well-managed plans that are doing right by their employees. And I know this is a complicated subject. I dealt with a number of issues as the chair of the New York State Assembly's Insurance Committee for a number of years. So these are challenging issues. But I wanted to ask Ms. Becker, I had a couple of quick questions, if I might. There are clearly structural issues in certain industries that have created challenges here. But that aside, if you could sort of isolate that and put that to the side as though that were possible, there are features of the healthier plans that I'd like to ask if you could identify those and help us take that into consideration throughout our deliberations. If you could sort of identify what sets them apart, I'd be grateful.
Sure. So the strong plans right now are very well funded. They are well managed. They have trustees who are representative of trustees throughout the multi-employer system who have taken proactive action to keep their plan in a healthy funded status, as they have suffered market shocks or what the case is. They also typically have a very strong active workforce where they are strong and growing, and the participants are continuing to contribute to the plans and earn retirement benefits that provide secure benefits going forward.
And that, you know, when it comes to some of those structural challenges in certain industries, those factors, however, separate out the healthier plans from those that are struggling despite the structural changes. I wonder if you could just comment briefly on the effect there would be in lowering the assumptions on interest rate used to value plan liabilities.
So that would be incredibly detrimental to all of the healthy plans that are out there right now. It would have an immediate impact on both the required contributions to these plans and to the benefits that they can pay out. We took a look at an example plan last year, and what we found was that, you know, if you immediately adjust the discount rates, you are looking at least a doubling of the contributions required to fund the same benefits. Or if you flip that around, you would need to take a dramatic reduction in the benefits that people have earned in order to keep the plan in a healthy situation.
Perfect. Thank you. Again, thank you to Chairwoman Wilson. I ask unanimous consent to submit the following letter into the record. It's a letter on behalf of the Multi-Employer Pension Alliance, discusses the importance of ensuring that any plan that addresses the pension crisis does not impose undue costs on healthy multi-employer plans.
Without objection,
back my time.
so ordered. I now recognize Mr. Fulcher for 5 minutes.
Thank you, Madam Chair. And first of all, to the panel, you probably know this, but apologies for not being able to be here for the whole thing. There's this thing called scheduling and needing to be at 2 committee things at the same time, but just know that you're appreciated and your testimony is appreciated. I have been able to stay on top a little bit of the content, and we're getting close to wrapping things up. But just a brief question, and this would go to Dr. Blauhaus. You know, some have said, obviously, that the financial downturn in 01 and 02, followed by the recession in 08, is the primary reason that multi-employer plan funding levels are in the status that they're in. And those are tough to predict, those swings. And so I would just ask, just to kind of summarize, what do you think can be done in order to best safeguard workers' retirement funding, just moving forward? What's the summary advice here?
Well, I would start by saying that with respect to those who point the finger at the financial market shocks and explaining the underfunding in the multi-employer plan universe, I respectfully but very strongly disagree with that assessment. Again, the single employer system has been through exactly the same financial market shocks, but it's in much better condition. And so that is not the set of factors that has caused the multi-employer system to be in much worse shape. What has happened is that you had multi-employer pensions were less well-funded to begin with. They're not properly measuring their liabilities or their assets, for that matter. The funding rules do not work very well. The premium assessments don't work very well. And importantly, during financial market recovery years, they have not rebuilt their funding position. You're going to have periods where your funding ratios are going to decline when the financial markets go down. What happened in the single employer plan universe is that, in fact, they actually took an even bigger hit in both financial market shocks, but in the recovery years, they rebuilt their financial position. So in 2007, you had much higher funding percentages in single employer plans than you had in, say, 2001, right after the dot-com bubble burst. You haven't seen that in the multi-employer plan universe. In fact, the funding percentages in the multi-employer plan universe have continued to decline even during the last several years of financial market recovery. So if the multi-employer plans are not now in well-funded condition, despite a decade that has been generally very, very good for the stock market, that's clearly not the problem. So I think it's very important that plans, again, they have to maintain an adequate funding position coming into, during boom years, during bubble years, so that they can withstand the downturns. And then when there are downturns and during periods of market recovery, they have to rebuild their funding position, which is not what has happened.
And if I may, as you look at this current circumstances through your lens, what's the trend?
Dire. It's very dire. I think I agree with the other panelists here that this is an urgent problem verging on a crisis and has to be dealt with quickly. But I think in some ways, the data coming forward from PBGC understates the problem. There's been discussion of the relative health of better managed, better funded plans, but again, a lot of that is illusory. A lot of that is based on actuarial assumptions that are not accurate. And so there is a lot of potential damage to the insurance system and to the security of worker pensions beyond what is contained in that $54 billion deficit. So I would say the outlook is very dire. I respectfully disagree with those who are saying throw money in now and do structural reforms later. I think that is an escalation, a continuation of current policy that has failed to date. And I can virtually assure everyone on this committee that they will be back here looking at a bigger crisis down the road if we put money in first and leave structural reforms for later.
Doctor, thank you. Panel, thank you. And Madam Chair, I yield back.
Thank you. I now recognize the esteemed Chairman Scott for 5 minutes.
Thank you, Madam Chair, and thank you for convening the hearing. And I want to thank you and the witnesses for pointing out that this is not just a problem for the workers and businesses. This is a problem for the federal government, because if we don't do anything, the federal government budget will take a significant hit, and that's been quantified a number of times. I also want to recognize and welcome David Durkee, who is the International President of the Bakery and Confectionery Union, as well as Chairman of their pension fund, who's dealing with this problem personally. I want to thank the Chamber of Commerce for your report in 2017. That report noted that this is not only a problem for businesses that can go bankrupt, but also for many of the workers who will end up on safety net programs. And I also want to thank you for pointing out as your number one concern, urgency is the important thing we have to look at. Madam Chair, I ask unanimous consent to put that report into the record.
Without objection.
Now, I want to thank Mrs. Becker for quantifying the problem we've got, pointing out that between 170 and 240 billion dollars is what we're on the hook for right now if we don't do anything, and point out that all of the legislative responses to the problem are a lot cheaper than that. So that the worst thing we can do from the federal government point of view is nothing. We ought to do something to address the problem, and that we're on the hook for those hundreds of billions of dollars over the course of time. As we consider so-called bailout, we have to recognize that we are on the hook, that the Butch-Lewis bill that hasn't been formally completely scored yet, but the guess is no more than 30 to 100 billion, which is significantly less than the cost of doing nothing. Madam Chair, I noted that a previous witness, Douglas Holtz-Eakin of the American Action Forum, has written, and I quote, that it's not simply a choice of committing federal funds or not for Congress. It's one of those pay me now or pay me later moments. And I would ask that his article from December 2018 be placed in the record.
Without objection, so ordered.
Thank you. Mr. Blehaus, you've talked about the premium being insufficient. I want to put that, try to get that in context. You said it's only 1/6 of the private sector. About how much per person is the premium now?
It's $29 per participant on the multi-employer side. It's $80.
Per what? $29 per what?
I'm sorry?
$29 per what?
Per participant.
Per what time period?
This is an annual.
$29 a year. Right. Now, we've heard Ms. Moorkamp said that for new employees, are you putting $15 an hour into the pension contribution for new employees?
If we're required to, yes, we are, but we're also paying $342 a week per teammate into our pension fund.
Okay, and that's the contribution. We've had a little, we tend to conflate the premium to the PBGC and the contribution to the fund. And so, Mr. Playhouse, if they're putting $300 and some a week, going from $29 to $200 or $300 a year for the premium doesn't seem like a problem, as big a problem as a six-fold increase would suggest. Is that right?
I think you make a very important point, which is there's a distinction to be drawn between premium payments and funding requirements. And those are two different animals. The premium assessments are what is required to keep the PBGC system solvent. The funding contributions are what is required to fund benefit payments to your workers.
But we can fix the premium. I mean, the cost to the employer would be negligible fixing the premium problem compared to what they're putting in.
I think this is such an important point that I'd like to elaborate on it, which is that you're right that we could stabilize the PBGC insurance fund. That's still going to leave a lot of workers with benefits that have been promised to them beyond the level PBGC guarantees that wouldn't be funded.
Well, if I could get one more question then, Madam Chair, because we've heard, Mr. Naughton, you've heard the back and forth over the impact of changing the discount rate. It seems to me that changing the discount rate to one that may be overly optimistic to one that's realistic, or whatever, however you change it, doesn't change the amount of money you have in the bank and the amount of promises you've made. What would be the effect of not going to a more realistic discount rate, even though it may trigger additional contributions? What would happen if you don't have a realistic discount rate?
If you don't have a realistic discount rate, then what you're essentially building into the system is the ability to promise new benefits that you do not fund, and to have the growth in existing benefits grow more rapidly than what you have on hand. So if you look at the last 10 years, we've had a couple $100 billion increase in the deficit. If we were to leave the contributions as is, based them on an unrealistic rate, then I would expect that that trend would continue. So, it's obviously, very important that we protect the Mr. Morgans of today, but if we don't change the discount rate, we're essentially going to have more people in this situation 10 years from now.
Thank you. I remind my colleagues that pursuant to committee practice, materials for submission for the hearing record must be submitted to the committee clerk within 14 days following the last day of the hearing, preferably in Microsoft Word format. The materials submitted must address the subject matter of the hearing. Only a member of the committee or an invited witness may submit materials for inclusion in the hearing record. Documents are limited to 50 pages each. Documents longer than 50 pages will be incorporated into the record via an internet link that you must provide to the committee clerk within the required time frame. But please recognize that years from now, that link may no longer work. Again, I want to thank the witnesses for their participation today. Thank you so very much. What we have heard is very valuable. Members of the committee may have some additional questions for you, and we ask the witnesses to please respond to those questions in writing. The hearing record will be open for 14 days in order to receive those responses. I remind my colleagues that pursuant to committee practices, witness questions for the hearing record must be submitted to the majority committee staff or committee clerk within 7 days. The questions submitted must address the subject matter of the hearing. Before recognizing the ranking member for his closing statement, I ask unanimous consent to enter the following materials into the record: a letter from the Horizon Actuarial Services, a letter from several construction employers, a statement from a participant in the Western Conference of Teamsters Plan, a letter from the Multi-Employer Pension Alliance, a letter from several labor unions and retiree organizations, a letter from the Pension Rights Center, a report from CRS on the cost of inaction, another report from CRS on selected histories of government assistance to private companies without objections or orders. I now recognize the distinguished ranking member for his closing statement. Mr. Wahlberg.
I thank you, Madam Chairman, and thank you for scheduling and holding this hearing as I said before, the first one of this subcommittee. It's extremely important. I remember going back to 2007 and talking to leadership of this committee about what I was hearing from my district, from Teamsters and other workers, as well as small business people concerned about this very issue of multi-employer pension problem. I didn't know what it was back then. Subsequent to looking into it, I began to see that this indeed was a ticking time bomb. I was told back then, oh, we'll get to it. It's not a real problem for 15, 20 years. But we're there. We're there. And while I applaud the efforts that we undertook in 2014 and what was done, it was not complete. And we've seen that. And we know that there are some other things we should have done, but that's water under the bridge or seeping out of the hole that we've dug. But what we have now is a challenge. And so I'm glad that we had this hearing, and I would hope that it would be only one of many meetings that we have that are substantial on this issue. I also hope that it will include all hands on deck, and thank you to the panel for being here. You've been very helpful with practical experience as well as practical advice and realistic depression-producing comments as well. But that ought to indicate that we need to get down to work. And so I would hope that all hands would be on deck from the industry that looks into this, oversees it, as well as the business community that is involved with it and is ultimately being hurt by it, and certainly the employees that see at this point in time little reason for expecting much for the future, and the retirees who don't have much chance or choice to make something different for their expectations. I'd also ask that officials, like a number of union officials, who aren't on the same pension plan that their membership is on, that they engage as well for the best interests of the membership. And I certainly ask, Madam Chairperson, that we as members of this subcommittee and members of Congress deal with this in realistic fashion. And so I'd end it by saying that in all of our deliberations, I hope we will promote reality. No pie in the sky stuff. Actual figures. Actuarials will do their job. Get that information to us as realistic as possible. That will have reality in what the deficit truly is, what the funding necessary for premium, as well as benefit payments, what the reality is for the liabilities that are out there, and who is liable, including the taxpayer, reality for the shared pain needed, because I don't think we can talk about this without assuming there will be shared pain in getting this done. And then also, Madam Chairperson, reality about the urgency of proper action. And I think you and I understand that that is not defined as political posturing, but proper urgent action to not let this thing go because of turf, because of jurisdiction, you name it. This is something that is important to people. We're talking about people. Numbers are connected, but we're talking about people. And so I thank you again for this hearing, and you have my commitment to do whatever is possible to achieve success for the people that we represent. I yield back.
Thank you, Mr. Wahlberg. I appreciate all of your remarks, and I'm sure that the audience does, and especially our witnesses. I now recognize myself for the purpose of making my closing statement. Thank you again to all of our witnesses for your testimonies today. Thank you very much. Today we heard how Congress's failure to address the multi-employer pension crisis will cause millions of retirees like Mr. Morgan to lose nearly all of their hard-earned pensions. It will also harm active workers and cost the federal government hundreds of billions in lost tax revenue and added Social Security net spending. We heard from Ms. Moorkamp and Mr. Spencer that this is a crisis that's not years in the future. It's impacting businesses right now. As our witnesses have made clear, Congress cannot afford to wait any longer. We must put aside our differences and act on a bipartisan solution to this crisis, a bipartisan solution like H.R. 397, the Rehabilitation for Multi-Employer Pensions Act, which would help rescue failing multi-employer pensions plans without cutting back benefits that retirees earned. Workers, retirees, employers, and taxpayers deserve action on this issue, and we must deliver for them in the weeks and months ahead. The price tag on any legislative solution is likely to be significantly less than the cost of doing nothing. I thank my colleagues for a constructive first help subcommittee hearing, and I yield back my time. And thank you for participating. If there's no further business without objection, the committee stands adjourned.